Right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is April 10th, 2025. And where to begin today? A lot has happened in the last 24 hours. We talked about it yesterday, said be careful out there, guys. Be careful on leverage. Who knows what we're going to be talking about tomorrow? Well, since yesterday, we spent all day yesterday morning talking about the mayhem in the bond market, how nobody knew what was going on. We speculated on what it might have been, but we had said very clearly, guys, it is the bond market you need to watch. It's what you need to be worried about. It's what policymakers are worried about. Now, I speculated yesterday on the stream that it would be the Fed that blinks because of the bond market. I was wrong about that. The bond market didn't make the Treasury blink, the Fed blink. It made Treasury blink. That's what happened yesterday. There's all kinds of spin going on, and the left is saying, oh, my God, he panicked and he quit and he backtracked. And the right is saying, oh, the art of the deal and 4D chess. And look, let's be honest. What happened yesterday? Cooler heads prevailed. People came to their senses. That's what happened yesterday. The bond market was freaking out. The destruction of the globalist world order was happening a little bit too fast for anybody's taste. And so they stepped back from the edge of the cliff. And man, the market loved it. A little too much, in my opinion. But boy, did the market love it. Yesterday, around 1 o'clock, I was doing a podcast with my new friend, Tommy Carrigan, invited me onto his show. And I come back from the podcast, and the market is just straight up green. What happened? The S&P rallied 9.52% in a day. One day yesterday. The third biggest single-day gain in the stock market since World War II. That's a fun stat. World War II was kind of a long time ago. Yeah, days like yesterday don't happen very often. By the way, the number one and number two biggest single-day gains in stock market history since World War II were both in October of 2008. So there's a cautionary tale in there. All right. By the way, 4 and 5 were in March of 2020. So you see where we're at here. This stock market sell-off is right now in the history books, right alongside the GFC and the COVID panic. Now, there's some interesting things about that. Those October dates of 2008 were not bottoms. All right. Those were bear market rallies. Those were huge swings, huge gains, and then the market resumed lower after that. The same can be said of one of those March dates when the market had a huge gain and then resumed much lower after that. Now, the only one of those days that you really want to be optimistic about was March 24th, 2020. That was the fourth or fifth biggest gains since World War II. Because that actually was a bottom. That was a V bottom. That was the low of the COVID hysteria, and the market went on a rip-your-face-off rally from there. So if you're looking at this situation yesterday and you're saying, well, the bottom is in, it's time to BT that F and D, well, keep in mind, bear market rallies are notorious bull traps. Of the 5 dates that I just gave you, all right, we'll say of the 4 other dates that I just gave you, only one marked the beginning of a rally. The other 3 were bear traps. Now, which one is it? I couldn't really tell you. I can tell you that a lot of things happened yesterday that made me suspicious of the rally. First, we got to talk about gold. Closed the day up over $100. Gold's behavior during that announcement yesterday was noteworthy. It initially sold off and it bounced right back up an hour and a half later. I'll show you the chart there. Gold is a flight to safety trade. And the fact that gold held its gains yesterday, despite euphoria in the stock market, should give you pause before you pile into this rally. All right, gold was flashing a warning as it was blowing past 3,100. By the way, gold up again this morning, still being that safe haven play. Oil ripped yesterday, like $5. I mean, we were talking in the morning about how oil was just cratering. It was down $16 in 4 trading days, like a 20% decline in the price of oil. Unbelievable global recession signal. Oil bumped about $5 on that news yesterday. Again, the enthusiasm was a little misplaced. Oil back down a little bit this morning. The 2-year Treasury. This is interesting because everybody's saying it was the bond market that made them blink. I agree. It was the bond market that forced this move yesterday. But while the 10-year and the 20-year and the 30-year were coming back down to earth, those yields were falling, which means the prices were rallying on that tariff announcement. we actually saw a big blowout move in the 2-year yield higher. So the carnage in the bond market was really just moving up the yield curve. And I've heard a lot of explanations. A lot of people are offering ideas about what that was. I'm just going to tell you, I don't know what that was, but a big move like that and something as deep and liquid as the 2-year treasury, that should give you a little bit of pause that rally yesterday maybe was getting a little bit ahead of itself. By the way, something I should note, that 90-day pause that was announced yesterday, that bared an uncanny resemblance to that fake headline from Monday, didn't it? Remember that story about the Hassett's quote and the Bloomberg terminal put it out and the market rallied and then the White House said fake news and the market went right back down? So was that just a test balloon for this announcement? Were they leaking that information to the press just to see how the market would react and then saying it was fake news, putting that thing back in the toolbox just in case they needed it? I got to say, there's probably a lot of people out there who owe Walter Bloomberg an apology after yesterday's announcement. All right. Now, I tried to point out in the video about the fake rally that, hey, this is not Walter Bloomberg's opinion here. Walter Bloomberg was just copy pasting a Bloomberg terminal post. That's all that was. But a lot of people were bad-mouthing him quite a bit about that story. All he is a parrot for a Bloomberg terminal, guys. It wasn't his idea. That's what I'm saying. Let's see what else happened yesterday. The British gilt market. Keep an eye on the British gilt market. You guys, I don't know if you remember October of 2022, the Bank of England had to abruptly start printing money again. Prime Minister Liz Truss was thrown out of office abruptly because the bond market in the UK was blowing up. It was being driven by this liability-driven investment scheme, which is basically a basis trade or a carry trade, very similar to what we warned about yesterday. And the big blowout in UK interest rates caused the UK pension system to nearly collapse in the middle of the night. That was October of 2022. We had very similar moves in the UK gilt market last night, or yesterday, I should say, 2 nights ago. We were watching those long-term gilt yields blow out. Now, today, the Bank of England has announced that they are canceling planned auctions for long-term gilts, the 10s, 20s, and 30s, the longer end of their yield curve. Instead, they're going to borrow short-term. That's a little panicky from the Bank of England. If they're canceling the issuance of new long-term bonds, it means they're worried about the bid for those bonds. They're worried there's not enough demand for them, and the prices might fall, sending the interest rates higher. And that's something that almost killed their pension system a few years ago. And in the context of this greater mayhem in bond markets, that's noteworthy. We've been talking about Japan. We've been talking about China. Keep one eye on the UK. We'll show you that story as well. It seems like the prevailing wisdom is that it was Japan that ultimately led to the move yesterday, though, that it was the bond market, specifically the bond market in Japan, the unwind of that yen carry trade that ultimately made Scott Bessent blink. And I think it was Scott Bessent because it seems like among all of the White House's economic advisors, Bessent appears to be the favored. You know, there's Navarro, there's Lutnick, there's all these other guys. Bessent seems to have the ear of the president, and the market seems to like that. Of all the people in the president's circle, of which the market is not fond of many of them, I should say, Bessent seems to be the favored choice here. And the fact that he's kind of steering the ship now appears to be restoring some semblance of calm into the market, for better or worse. What else do we got going on? Bitcoin rallied like crazy yesterday. Not surprising considering the rally in risk assets yesterday. Apple stock was very interesting. Apple had its best day in history, rallying more than 15% yesterday on that news. Now, look, the tariffs on China went up. That's important, all right? While everybody else was getting reset to 10% in the tariffs yesterday, China got another 25%. I mean, we were talking about 113% yesterday, so now it's 138. At this point, does it even matter? Is anybody going to pay 138% tariffs? No, they're not. And I think that's kind of the point. Nobody's going to pay the tariffs. Nobody's going to buy their stuff from China anymore unless they're absolutely forced to. And if they are absolutely forced to, you better bet they're going to move heaven and earth to make sure they don't have to pay those tariffs for long, and they're going to start shifting their production somewhere else. So it was weird to see Apple stock rally so much because Apple's largely dependent on China. Now, it's possible that the fact that India was given a reprieve from the reciprocal tariffs, India's tariffs were knocked down to 10%. Apple has been slowly moving into India. Maybe that's driving it. But also there's whispers of possible exemptions for companies. And to be honest with you, that kind of pisses me off. All right. If small businesses are going to get clobbered, if dollar stores are going to get killed by 125% tariffs in China, then there's no reason to give Apple a reprieve, right? We're all in this together or none of us are. That's my opinion on that. But it looks like there are whispers that individual companies may start getting exemptions from the tariffs. So guys, it's time to pay up for the best lobbyists in Wall Street. I guess that's the lesson there. And also, speaking of nobody wanting to pay those tariffs, there was a story yesterday. Amazon started canceling inventory orders for goods coming from China. So already those exports from China are starting to take a hit. Amazon has no intention of paying those 125% tariffs. Now, let's talk about what the actual change was yesterday. There's a 90-day pause on the reciprocal tariffs. That's the boards, right? The placards that Trump held up last week. All of those numbers are now going to be 10% going forward, all right, for the next 90 days while we talk. Everybody but China. China's getting an extra 25%. So a bit of a middle finger to Xi Jinping there. Canada and Mexico, also no change. Those were specific tariffs. Those are not affected by this pause. Also, specific tariffs on things like steel, aluminum, and autos. Those are unchanged as well. So, guys, it wasn't like the trade war ended yesterday, all right? There was like, there's this great big battlefield. One section of the battlefield, there was a temporary ceasefire. And everybody's like, yay, the war's over. Not quite. It was certainly good news. Was it great news? No. Was it euphoric news? Absolutely not. And I think in the long run, the market's probably going to pay for that ridiculous rally we saw yesterday. Also this morning, guys, inflation came out. Inflation beating expectations to the downside. I wouldn't get too used to that. The market doesn't really seem to care too much about that. We actually saw a little bit of a weakening of the dollar in response to that lower inflation print. But watch out for that weakening dollar. Remember that yen carry trade is out there. If we see the yen continue to strengthen against the dollar as it weakens on things like low inflation prints, watch that yen carry trade. Somebody in Japan was on the brink of blowing up yesterday, and I don't know that a 90-day reprieve in tariffs is necessarily enough to stop whatever it was from happening. We got a lot to talk about. Once again, guys, why don't we shrink my big melon of a head and let's see what's happening in the world of finance this morning. And for you new guys here, if you wouldn't mind, that like button and that subscribe button for the YouTube algorithm. Come on back tomorrow and have your coffee with the melon heads because we do this one every single day. Right now, the S&P 500 is down by 109 points, 2 points lower after that blowout. 2% lower after that blowout 9.5% rally yesterday. I don't know if this is necessarily a resumption of the panic after a big move like yesterday. I would expect some red candles here. Let's wait and see where we actually go. Now, just to appreciate the size of the move, these are now daily candles. Now, first of all, it's never a good sign when your chart, when the candles start overlapping with the volume bars. That's typically not a good thing when you see that in markets, but just look at the size of the move. Now, keep in mind, guys, these moves right here, these candles, these are massive moves to the downside. Market doesn't usually do that. And then look at this big, giant green candle yesterday, wiping out about 2/3 of the total losses since this trade war was kicked off. But again, guys, I got to warn you, these bear market rallies. They are notoriously volatile, and they can reverse on a dime. And here's the other days, by the way. This is from CNBC using FactSet data. These are all of the biggest one-day gains since World War II. There's the third one, April 9th, 9.5%. The two biggest ones, October 13th and October 28th of 2008. Those were not bottoms, guys. The market kept falling after that. So again, those were bull traps. March 24th of 2020, that was a bottom. That was a V bottom. That rally was legit. The market would go on to rally for pretty much 2 years after that. But March 13th, 11 days before that 24th bottom, that was another bull trap. So it's worth keeping in mind, guys, these big rip your face off rallies, these single day spikes, they're not necessarily an end to the carnage. It's just indicative of the overall volatility. Now, looking over at the Dow futures this morning, they're also down 562 points, about 1.4%. And the NASDAQ is leading the way lower, 2.35% down. That's about 447 points to the downside. So we got stocks down across the board this morning. albeit kind of a tame move versus what we've seen in the last few days. Now, let's look again at the global indexes. You can see Germany, euphoria in Germany, 5.5%. By the way, Ursula von der Leyen is out today saying Europe will reciprocate and they will pause for 90 days. We'll read the quote from Ursula today, but Europe is pausing their retaliatory tariffs. So at least they're talking. That's a good thing. They're not singing Kumbaya yet, but the DAX doing really well. The British FTSE is up 4.4%, doing pretty well over there in England. The French CAC 40, that's up 5.4%. The Spanish index, 5.5%. Now, look over here in China. Why are the Chinese indexes green here? Sense. This makes none. The Shanghai index up 1.16% this morning. China's tariffs went up another 25% yesterday. Chinese stocks should not be higher. I don't know, is the home team buying here? I don't know what this is, but I don't have too much faith in this move in Chinese stocks here, unless the Chinese government is firing off the stimmies again. You got the Shenzhen is up 2.25%, the Shanghai at 1.33%, the Hang Seng, that's Hong Kong stocks, up 2%. I really don't get the move in Chinese stocks here. That just doesn't make any sense to me. Meanwhile, the dollar is weaker this morning, largely off of that CPI print, although the dollar was weakening pretty much all night. That's noteworthy. Things in Japan, the yen continues to strengthen. That means that yen carry trade is worth watching, even though, by the way, going back to the international indexes, the Nikkei up 9.13% yesterday. The Japanese stocks were ripping on that news. Don't know what to take away from that either. But again, the bond market is what you really need to watch here, not so much the stocks. Where were we? We were on the dollar. We saw the dollar strengthen a little bit here. Or actually, I'm sorry. We saw the dollar weaken on that CPI print, bounce back a little bit. Now it's heading lower again, down 139 basis points, 101.6. The dollar has weakened dramatically in the last couple of weeks. Now, you got to watch this level. I've been showing this a couple of times a week here, the USD JPY chart. The yen is strengthening again versus the dollar this morning. Just want to zoom in. Here's August 5th. All right, we're right in that August 5th yen carry trade panic range. But look, yesterday we had a pretty substantial weakening of the yen on that tariff news. You can't see it again because we're overlapping with the volume bars. But the wick on the yen candle goes all the way down to 143, about 144 even yesterday. And then, of course, we ended up closing the day a lot higher. So the yen weakened substantially versus the dollar on that tariff news. Now we're giving all that back. The yen is re-strengthening today. So whoever was about to blow up in Japan yesterday got a stay of execution, but they're not out of the woods. That's my takeaway from this chart. Watch Japan, guys. That's a close one. You also got to watch England. We'll talk about that in a second. First, the U.S. bond market. All over the place, guys. The bond market just crazy here. The 30-year Treasury is actually a little bit higher this morning. We're starting to see some movement on the long end of the curve. Yields were largely lower across the board. And I'm surprised to see that 30-year going green here. Keep an eye on the long end of the yield curve today. Things change very rapidly, guys. By the time videos are made and posted and uploaded, the news is obsolete. So you got to watch closely. The 10-year, 4.340, that's down by 5.5 points. That was down double-digit points earlier today. The 2-year, 3.864, down 8.5 points. Looks like the big move right now is in the 5-year. That's 9 points lower. Even the 1 month is a little bit lower here, almost 2 basis points at 4.312. Also, I want to talk about what happened in the 2-year yesterday. This is pretty interesting. While most of the bond yields fell yesterday on that tariff news, the 2-year yield spiked, which means people sold the 2-year Treasury yesterday. I don't know what that means, all right? And people who are afraid to say, I don't know, historically cause big problems, and that's why I'm saying that. Like, I don't claim to be an expert on the inner mechanics of the bond market. Be highly skeptical of anybody who does. But as soon as those tariffs were announced yesterday, we actually saw a monster sell-off in the 2-year. While the rest of the bond market was experiencing a relief rally, the 2 sold off. Now it would give back some of those gains in the yield, and it would ended up, it's pretty much about half of what it was at that point. I just don't know what this is, but a big move in a deep liquid market like this, plus the move we saw in gold, which we'll look at in a second, that made me very skeptical of this rally. Now, also something to worry about, BOE to auction short, not long maturity bonds on April 14th. This is a little panicky from the Bank of England this morning. This is in breakingthenews.net. The Bank of England said on Thursday in a statement that due to the recent market volatility, it will be auctioning long maturity bonds, but it will not be auctioning long maturity bonds, but rather short ones on April 14th. The bank intends to reschedule the long maturity auction to the following quarter in order to continue to reduce the asset purchase facility as evenly as possible across maturity sectors measured in the initial proceeds terms. So they're trying to sell off all those bonds that they had to buy in 2022 in order to stop the gilt market crisis. And now after what happened yesterday, they're saying, nope, not going to do that. We're going to sell some of the shorter dated stuff instead. The schedule for Q2 is otherwise unchanged. It was detailed in the statement. So watch the UK gilt market, guys. Watch those pension schemes going on across the pond. Now, looking over at the commodities board, we got metals are deep green again today. $51 higher for spot gold, $3,135. That's on top of the $100 it picked up yesterday. Gold is ripping here. Safe haven status is working for gold. Silver along for the ride, not as much. It's only higher by a penny here. Silver's actually about to go red. That's noteworthy. Keep an eye on silver. $31.03 for spot. Even though the front month silver contracts are up by about 60 cents, they're actually at about parity here. There you go. Silver just went negative. That's interesting. Copper, meanwhile, is higher by 4%. That's that relief rally in the global economy. Dr. Copper saying, yay, everything is over. The trade war is not going to happen. I wouldn't trust that. Meanwhile, platinum is higher by about 2.1%. Palladium is higher by 2%. Crude oil starting to give back gains here. It ripped yesterday on that tariff pause. Now it's down about 3.4%, right around $60.21. That's off by about $2 versus yesterday's price. But it's that gold chart I want to look at, guys. Another thing that made me very skeptical yesterday of that big move that we saw in markets was gold's behavior. All right. Initially, the markets entered this euphoric state on the announcement. You can see here on the chart, right as the tariffs are announced, gold sells off. All right, if we are seeing this euphoria rally, that makes sense. People selling safe haven assets, moving back into risk. There's corresponding moves in stocks and Bitcoin. Okay, that makes sense. But then an hour and a half later, we see gold spike right back up to where it was before. Meanwhile, stocks just continue ripping the whole time, but all of a sudden there's safe haven demand once again. I don't know what that means, but I can tell you that means at least in the gold market, there was not euphoria about risk assets. All right. People were de-risking while everybody and their brother was buying stocks yesterday and buying Bitcoin. Somebody was buying a lot of gold for safety. That is noteworthy. Gold moving higher again this morning shows that continues. Now, let's talk a little bit about some of the things going on. This was big news this morning from Ursula von der Leyen. She's the head of the European Union. She says, we took note of the announcement by President Trump. We want to give negotiations a chance. While finalizing the adoption of the EU countermeasures that saw strong support from our member states, we will put them on hold for 90 days. So they're reciprocating the 90-day pause in the reciprocal tariffs. If negotiations are not satisfactory, our countermeasures will kick in. All right. So right away, she's kind of like getting a little bit more defensive in her posture. She's keeping her dukes up. Preparatory work on further countermeasures continues. We're ready to tariff if we have to. As I have said before, all options remain on the table. So this is kind of like an olive branch with a middle finger in the other hand from Ursula von der Leyen. Hey, they're talking. What's the worst thing that could happen, right? At least they're talking. That's encouraging. Now, let's talk about this move in Apple because this was kind of suspicious. Apple stock jumps on tariff news and hope for an exemption. And you know what? Let's just cut it off right there. That's the story. Hope for an exemption. Why does Apple get an exemption? Why are big corporations going to be exempted from tariffs? Or why are we even entertaining the thought of exempting big corporations? I thought the whole point here was to save Main Street. I thought the whole point was too often Wall Street has gotten rich at the expense of the little guy. And I can get down with that message. All right. I'm on board with that. I will carry that flag into battle if need be. But if you're going to give Apple an exemption, I'm going to drop that flag and I'm going TF home. That's for sure. We are all in this one together or we are not. Either fight or don't. Don't start like, oh, the rich kid's son, he doesn't have to go to war. We only draft the poor kids, which, by the way, is pretty much always how it happens. So Apple stock, look at this, 15.3% rally on hopes of an exemption yesterday. Well, they better hope that exemption actually happens because if they don't get an exemption, the 25% additional tariffs, we're up to like 134 or something like that for anybody who's counting. Yet they're 138. Does it even matter? Once you're over 100%, who cares? Apple better hope they get an exemption. If not, that 15% rally is going to evaporate. And they're giving back about a third of it already this morning, down 4.7% to $189.14. Also, interesting news yesterday. Amazon cancels some inventory orders from China after tariffs. I got some message from people saying, what are they thinking? Who's going to pay 100% tariffs? I think the point is they're not going to pay. And that's the whole point. People aren't going to pay these tariffs. And that hurts everybody. Trade wars are wars of attrition. And here's Amazon canceling orders from China. This one broke yesterday afternoon. Amazon has canceled orders for multiple products made in China and other Asian countries, according to a document reviewed by Bloomberg and people familiar with the matter, suggesting the company is reducing its exposure to tariffs imposed by President Trump. The orders for beach chairs, scooters, air conditioners, and other merchandise from multiple Amazon vendors were halted after Trump's April 2nd announcement that he planned to levy tariffs on more than 180 countries and territories, including China, Vietnam, and Thailand, the people said. Notice there, chairs, scooters, air conditioners, beach chairs. Sorry, these are seasonal items that would be ordered now to be for sale in June, July, right? Those, they're not getting ordered here. Amazon declined to comment. One vendor who has been selling beach chairs made in China to Amazon for more than a decade received an email from the company last week that said it was canceling some purchase orders that it placed in error and instructed the vendor not to ship them. The email, which was reviewed by Bloomberg, didn't mention tariffs. By the way, Amazon, you're full of it here. You didn't place that purchase order in error. You changed your mind after the tariffs, and now you're lying to try to get out of paying that 125% tariff. Screw the little guy. The vendor said the $500,000 wholesale order was nixed after the chairs had already been manufactured, leaving this person on the hook to pay the factory and find other buyers. The vendor, who spoke on condition of anonymity for fear of retaliation from Amazon, said the company had never canceled one of its orders in such a manner. Now, this is important here, guys. This is small numbers, right? $500,000, that's a lot of money to you or me. It's not a huge deal for Amazon. But think about the guy who's now stuck with all those chairs and no buyers. Did he borrow that $500,000 in order to get them manufactured? And now he's got nobody to sell them to. He's going to have to mark down his price to find some other buyers somewhere else, hopefully enough to cover the money he borrowed to get that order made. Now you're starting to see counterparty risk. This is kind of the source of some of this panic in the bond market here. People are worried that debts won't get paid, that these companies that operate very close to the brink of insolvency are going to be pushed over the edge by these tariffs. And this vendor with the chairs is a perfect example of that. Meanwhile, we got inflation. And by the way, every time I see this picture of Jerome Powell, I can't help but think of that meme that somebody photoshopped in Janet Yellen. It skeeves me out every time, but I digress. Fed leans against inflation and away from preemptive rate cuts. Keep in mind, this is 7 months after they leaned away from inflation and into preemptive rate cuts back in September. Gee, I wonder what changed since then. But the Federal Reserve officials are prepared to hold their policy rate steady to minimize the risk that President Trump's tariffs trigger a persistent rise in inflation, even if the labor market softens further. In public comments and interviews, a number of officials have sent a clear signal. They are ruling out interest rate cuts that would act as an insurance policy against any tariff-induced economic slowdown. Policymakers are instead doubling down on their laughable commitment to inflation and Americans' expectations for price growth, keeping them in check, a posture that will likely keep them on hold absent a significant rise in unemployment. So, guys, the message from the Fed here, it's been pretty consistent for the last week or so. The Fed is not on board with the trade war. They are not going to rescue the bond market. And this is why Trump was forced to blink yesterday. This is why, we'll say, Bessent convinced Trump to blink yesterday. And I know I'm going to get some guys in the comments are saying, oh, Trump didn't blink. Oh, you're swallowing it. Guys, he blinked. Trust me. It was the panic in the bond market that made him change pace yesterday. That anybody who's looking at the numbers and understands what they mean knows that's what happened yesterday. Whether it was a long-term win or whether it was the plan all along, you can debate that until you're red in the face. The bond market won yesterday. And there is this game of trick chicken going on between the Fed and the Treasury. The Fed held pat yesterday, said, nope, we're not riding to the rescue, and Bessent was forced to back off. This was a game of chicken between Treasury and Fed, and Treasury blinks first. Now, is that going to continue? We don't know, but the Fed is claiming that they're more focused on the fight against inflation, even though we just got inflation, and actually it wasn't that bad. United States inflation rate, 2.4% year over year. There's the CPI print. It just came out. By the way, look how far we've come. People barely notice CPI prints now. Remember where we were 3 years ago? Everybody watching every little fine-tuned nook and cranny of the inflation reports. Now people are like, it's an afterthought. 2.4% year over year. That is versus 2.6% expected, a beat to the downside, and down sharply from 2.8%. Don't get used to it, guys. We're not going to be down here for long, not with 125% tariffs. Meanwhile, the month-over-month inflation rate actually went negative. Look at that. It was largely driven by gasoline. I don't think there's going to be that much relief from people, but month-over-month, negative 0.1. That's versus expectations for positive 0.1 and down from 0.2 last month. So inflation moving lower, and the headline numbers largely influenced by energy. Core inflation was not quite as good, but still heading in the right direction. Core inflation, 2.8% year over year. That's versus 3% expected. So it's a beat low and down from 3.1% last month. So core heading in the right direction. And on a month over month basis, core was still positive, 0.1% versus 0.3 expected and down from 0.2. Any way you look at it, guys, inflation beat to the downside. Still well above the Fed's arbitrary 2% target. We never even got close to that. And it's not going to be here long. It's about to get worse when these tariffs hit. And that's why I think the market just doesn't really care too much. Some noteworthy things within the report. The food index went up 3% year over year, a 0.4% increase for food. That was driven by both food at home and away from home. So food got a little bit more expensive last month. That's worth keeping an eye on because that hurts the poor more than anything. Energy, though, got a lot cheaper. If there's one thing that hurts the poor, it's food. If there's one thing that helps the poor, it's cheaper energy. And energy got a lot cheaper last month. Negative 3.3% year over year, negative 2.4% month over month. That was driven almost entirely by gasoline, dropping significantly, 9.8% to the downside year over year. Gas got a lot cheaper. Now, that was partially offset by electricity getting more expensive. Some other things that were noteworthy, new vehicles got a little bit more expensive on a monthly basis, 0.1%, but flat year over year. Used vehicles actually got cheaper last month. That's interesting. Negative 0.7% after a big 0.9% increase the month before that. So we gave back some of those gains from last month. On a year over year basis, used vehicles were 0.6% higher. We had a 0.4% increase in apparel. Medical commodities got a little bit cheaper. The shelter index, 0.2. That is noteworthy. That's the first 0.2 read in shelter for a while. We're finally seeing some of that housing inflation come down. Man, that took long enough. That owner's equivalent rent index is stubbornly high. It's a lousy statistic, but we've been bouncing around between 0.3 and 0.5 for like 2 years here. Finally, a 0.2. So a break to the downside on shelter inflation. That is noteworthy. And transportation services continues to head lower, negative 1.4% for the month. I think that's largely being driven by airfares. We've seen a lot of bad headlines from the airlines recently. I think that is showing in the transportation services index, which is still 3.1% positive for the year. So inflation looking pretty good here. Last but not least, one more I got to talk about. You know you're not going to get through a stream without some commentary on the AI bubble. Trump administration backs off Nvidia's H20 chip crackdown after Mar-a-Lago dinner. So it seems Jensen Huang went to dinner with President Trump, probably wearing his most formal of motorcycle jackets, and he came out of that with a win for export controls. This is kind of important. The Trump administration has reversed course on plans to restrict exports of Nvidia's H20 AI chips to China after CEO Jensen Huang attended a Mar-a-Lago dinner last week, NPR reported on Wednesday. The planned American export controls on the chips, the most advanced AI processor legally available in China under the export controls, had been in the works for months, NPR reported, citing two sources, and were ready to be implemented as soon as this week. The change in plans came after Nvidia promised the Trump administration new U.S. investments in AI data centers the NPR report said. New investments in data centers. So this is pretty interesting because Nvidia gets a win here, right? Less export controls on these H20 chips. And let me just say, it doesn't matter because Nvidia doesn't care about export controls, do they? As soon as the export controls came out, all Nvidia started doing was sending the things to freaking Singapore and Malaysia, where they would just spend a few minutes in a crate and then onward to China anyway, while playing dumb and acting like they had no idea it was happening. So why does Nvidia care about export controls at all? They're getting 20% of their sales right now from illegal sales to China. But the hilarious thing was that they managed to secure this export controls win that they didn't even really need because they break the law whenever they want. They did it by promising to invest in data centers. So what is Nvidia really doing here? They're going to buy more chips from themselves in order to get Trump to back off the export controls. More round tripping. You got to love it. You just can't get a headline about Nvidia without some kind of accounting shenanigans these days. I'm telling you, this is right after Microsoft backed off their data centers in Ohio yesterday. Remember, Microsoft is going to plant corn instead of building a data center with the land they bought in Ohio, who had Microsoft farming corn in their 2020s bingo card. And now Nvidia is blowing harder and harder into the bubble. Keep blowing, Jensen. It ain't working, buddy. Keep blowing. And I just want to say thank you very much to Miss Viv B. Thank you, Viv. I appreciate the super. That's not a super chat. Thank you for the 5 Nobody Special Finance memberships. Welcome to the Melonheads, you 5 glorious Melonheads. You be sure and say thank you to Viv. Viv, once again, thank you for everything you do for the channel. Richard Bell, what's going on, brother? He says all this tariff, a propaganda distraction, theater. Jack, where is all the promises like the Epstein list, et cetera, et cetera? I'll be honest with you. I think the Epstein list was the theater in this case, Richard. That whole thing with the binders and the influencers holding up the binders, which was just information we already had, that was a circus act. That was a joke. Look, neither party's going to release the Epstein list because both parties are all over it. That's why it's not going to happen. That's why we're never going to know. They were all doing it. And so they'll promise to release it to get elected, and then they'll not release it. Both parties, both of them. It sucks, but it's what it is. I don't think tariffs is a propaganda distraction. I really don't. To be honest with you, the blow up in the bond market, the trillions of dollars that have evaporated before our eyes in the last couple of days, that's not theater. All right. Wars have been started over much less money than that. That's legit. You better believe that's real. The Epstein circus, that was political theater. I wish it wasn't. But this is real. This trade war, this is one of arguably the most historically significant event probably since COVID. COVID was probably bigger. Maybe history will view this as an extension of the COVID crisis. I don't know. But as far as economics and the upset to the global order, this is the biggest event since we went off the gold standard in 1971. I mean, I don't think this is theater by any measure, Richard. But thank you, sir, for supporting the channel. I appreciate that very much. Pigo's trading desk says, dude, Janet Yellen on the tariff blink. Well, I would just say that the tariffs are reckless, and gee, I really liked it back when the guy who didn't know what time it is was in charge, and all he had to do was show up on time to get his diaper changed and drink his prune juice. And then I was able to continue to issue less long-term treasuries and recklessly lean on the T-bill market, knowing my predecessor was going to, or I'm sorry, knowing my successor was going to have to clean up my mess. And so I'm just sitting here collecting my speaking fees from all the banks I served while I was in office, laughing about what's going on in the market. And that is Janet Yellen talking about the tariff blink or the flinch. Yeah, Yellen is laughing all the way to the bank here. She's collecting on all the favors that she did when she was in office. I don't think we'll be hearing too much from the Janet for the near future. But I know you guys miss Janet. I know. It's like this. It's like this economic Stockholm syndrome. You guys really wish she was come back just so we could hear from her. Thank you very much for the laugh this morning, Pigo's Trading Desk. And thank you, everybody, for having your coffee with the Melonheads. It is still a mess out there, guys. And just be careful. News, as soon as it hits, it's already obsolete. So keep a watchful eye. Be mindful of what you hear in the headlines. Watch out for the fake news. Watch out for the distractions. And be careful on leverage, please. Thank you so much, everybody, for the super chats, for the support of the channel. Thank you to my Patreon supporters and magnanimous Melonheads on YouTube. You guys rock. Links down below. Don't forget that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. Love you guys. Until next time, everybody, live small and dream big.